Okay, good morning. We have a handout today. If you're just walking in the door, grab the handout. There you go. Okay. If you're online, the file is being pushed out to you. This is the same PowerPoint file essentially that's online for Chapter 13. There's so much writing for today. I wanted the ability to move through, and I'm guessing everyone has a lot going on and would prefer to get out of class a little bit early too, right? So we have, hence the handout. So we're going to go pretty quickly today, do some homework problems. Before we get there, though, we're going to have the administrative. So again, pick up the handout at the door if you're just walking in. There we go. Good. Thank you. Okay. So first things first, we have a question about learning catalytics. When performing vertical analysis of an income statement, net income is usually used as the base. This relates to what we did Monday. On Monday, we said if we were doing a balance sheet, we would divide by total assets. And then we said if we were doing an income statement, what would we divide by? So this question, it's actually, we don't divide by net income, we divide by sales revenue. So you need to know the two bases. For balance sheet, it's total assets. For income statement, it is sales revenue. So this question's false. The question will be open for a couple minutes. It's going to close at some point. So make sure you get logged in and get it answered. Okay, and what we're going to do today, do the administrative stuff and then finish up the chapter. And as I said, I think we're going to get out a little bit early. Okay. First of all, final exam. So the final exam is over chapters 9 through 13. It is not cumulative. It is what we've done from chapter 9 to now. And it is Monday, December 14th, starting at 8 a.m., and you have to start it by 4 p.m. Thursday, December 17th. Waiting to start it at 3:55 on Thursday is not a good strategy at all. In the labs, there can be lines, and ProctorU, if you're taking it with ProctorU, remember this is their crunch time too. You might have the equivalent of lines at ProctorU. It could take longer to get online than you normally take. So don't wait till last minute to do it. You want to make sure, also if you're in section 7 or 8, make sure that you've scheduled with ProctorU so you get the best selection of times and dates. Okay, what's due this Saturday? Chapter 13 homework is due Saturday. The extra credit is due if you're doing it. There are no extensions. So homework is over at 11 p.m. Saturday. No more extension. It's done. It's over with. Practice exam 3, which counts as a quiz, is due before you take the exam. So you've still got that available to you. Just as an aside, if when you're taking the practice exam, I had someone that emailed me last night and said I fell asleep during the practice exam and I used up my attempt. Your practice exam attempt is not used up until you click submit. If you ever lose a connection during your practice exam or your computer freezes or something weird happens, as long as you have not hit submit, you can go back into it. All you have to do is restart your browser. Sometimes you need to go back into your browser or restart your computer, worst case. Go back into it, click on take a quiz, and then click on it, and you will be back in your original attempt, okay? So all homework is due Saturday. Saturday is the last day to submit any homework and the last day for extra credit. What to expect during finals week? Your 3 lowest quizzes. So your syllabus says 2. I've made it 3 to give you a little bit of extra leeway there. They will be dropped Friday, December 18th. I can't drop them before because the practice exam counts as a quiz. I can't do any drops until that practice exam is over. So I'll drop your 3 lowest quizzes. Once I drop the quizzes, you will be able to tell I dropped the quizzes because in my accounting lab, if you click on results and review your past results, your quizzes that are no longer counting will be grayed out, and I think they'll be visibly grayer than everything else, and it'll say low score or something like that. There is no mathematical way that my dropping 3 lowest quizzes will lower your course grade. The quiz is based on a percentage, so it's a percentage of the quizzes. If I drop your 3, if you've got 100% average and I drop 300%, you will still have 100% average when we're done. Okay. I will be working on grades at the latest Monday, hopefully sooner. I know your grades are important. I would be obsessing over seeing my grade even if I knew it. I'd want it. So I know it's important, and I will get grades done as soon as I can. Once I have the grades entered in Flashline, I will email you out and ask you to check your grade in Flashline, because I'd like you to check it to make sure that I didn't make some gross error. Doesn't usually happen, but just to make sure. Yes, practice exams are counted as quizzes, and they can also be dropped. So there's 3 types of quizzes per se that can be dropped. We had a course intro quiz at the beginning of the semester. That's a quiz. Every Learning Catalytics day is a quiz, and all the practice exams count as quizzes as well. So your 3 lowest of that group, of that entire group, get dropped. Okay. Okay. Now, I don't mean to sound harsh by this, but I will not adjust one individual person's grade. So if you write to me, let's say you have an 89.9. I am not rounding, okay? If you have an 89.9, that's a B+. I will not adjust your grade. After this week, after homework's done, after the extra credit's done, there are no other assignments other than obviously the practice quiz and the exam. There's nothing, no more work you can do. I will not create another assignment for you to do to up your grade. I will not bump one person's grade. That said, I will treat everyone exactly the same. So if I bump everyone, if I give anyone the benefit of bumping, everyone gets bumped. And I don't know what I'm going to be doing until all grades are done. But I can guarantee that there will be people on the bubble. So if I bump an 89.9, then what about the 89.8? Because they only missed it by 0.1 at that point. So those cutoffs are there. I'm not going to adjust an individual person, but I treat everyone the same. So, and I don't know what your final grade is. I can tell you my best estimate of your final grade is the grade showing in My Accounting Lab. If you go in My Accounting Lab course home, you click in results and then overall score, that gives you your grade in the course to date. If you want to know what grade you want what grade you need on the final exam in the course, if you go to Blackboard, right on the home page there's an Excel sheet that you can download and put in your averages to date, and it'll tell you it's an approximate estimation of what you need on the final to achieve a certain grade in the course. Okay, so let's see. Your 3 lowest quiz scores will be dropped Friday, and I'm going to treat everyone the same. So let's see where we go. Okay, now extra credit. So extra credit right now resides in homework in My Accounting Lab. There's no technical way for me to extract it right now. So as long as it's available, it's in there, and it is technically impacting your My Accounting Lab grade because it's in there. But it's due Saturday night. Saturday night will go by. Sunday, I am removing the extra credit from My Accounting Lab. So the extra credit assignment, the extra credit will disappear. You will not see it. You will actually never see the 2%. If you completed all 10 steps and you got a score of at least 80% on each step, then what happens when I go to do grades, after everything's in, I download them to an Excel sheet. What I'm going to do is I'm going to go through, I'll have a list of everyone who completed the assignment, and I will add 2 points to your score, so when I'm doing the grades in Flashline, that's where the benefit will be felt. So the 2% will not show up in My Accounting Lab. The extra credit assignment's coming out Sunday after it's due. So it's coming out. You won't see it anymore. It won't impact anything. And the 2 points, if you've earned it, it will get added in behind the scenes, but I will take that into account. So you will have 2 points added to your score. Okay. 11 p.m. I think everything's cutting off at 11 p.m. Okay, there's a question. There was a homework assignment I never did. Should I do it or just leave it alone because it could potentially lower my grade? If it won't impact your grade if you go into it now. I would probably tend to say go into study plan and practice there. Weird situations have happened. If it's a homework that was due just last week, I would still do it this week. You could still get a little bit of credit for it. But if it's older than a week, I wouldn't touch it. I'd just be in study plan. At this point, if you didn't do a homework, I would be concentrating my efforts on study plan and on the practice exam. Okay, so you're not going to be able to do it for credit. Yes. Okay. So extra credit. Okay. So extra credit. Details are in Blackboard. It's due Saturday, December 12th, 11 p.m. Okay, there is no extension, no partial credit. To get the extra credit, you need to complete all 10 steps with a score of at least 80% on each step. I've had a couple people, and there could be more, I haven't looked through everyone's, will skip a step and the overall score is above 80% on the whole thing, and they think that's okay. That's not okay. You have to complete all 10 steps. The extra credit, most of the extra credit, if you're not sure what you're doing on it, look at chapters 2 and 3. Most of the concepts on the extra credit are in chapters 2 and 3. We might see a little bit from chapter 1, maybe a little bit from chapter 11, but most of it is centered in chapters 2 and 3. Now, if you have a question about one step, what you need to do is you need to take a screenshot. If you can't take a screenshot, you can take a picture with your phone, but take a picture close enough that we can see the numbers, okay? So take a screenshot, send it to me. In the subject line, put exactly what step you're on, and then explain what you've done that's not working, and we'll get back to you. If you have a question, if you're lost and you don't know what to do at all on more than one step, it's time to get tutoring help. And tutoring is through the Academic Success Center. There is a tutoring link on Blackboard, and you can go to tutoring. We've got today, Thursday, and Friday. Still tutoring is available at the university. I would head there. But if you're stuck on a particular step, send a screenshot, send the email, but that has to come in by 1 p.m. on Friday. After 1 p.m. on Friday, plus it's not an assignment you can just do in one sitting on Saturday, so you will have had to start it by then. After 1 p.m. on Friday, you'll get an auto response that says, here's a list of hints that have helped other people with step-by-step. So we'll have that for you. So 1 p.m. is the cutoff on Friday for getting help with extra credit. Again, I would urge you to go to tutoring if you're floundering a little more than just needing help on one step or something like that. Okay, so office hours during finals week. I'm going to be in my office finals week, Monday and Wednesday, 9 a.m. to 11:30 a.m. I'll be sending out an email announcement over the weekend so to give you those hours again. So do come and see me if you have any questions, if you need anything, I will be there. Okay, so questions about anything to do with administrative, like what's happening. Seen some in the chat room. Can you post a general help email before 1 p.m. on Friday? We don't have it yet. I'm not going to put up an auto response till 1 p.m. on Friday. We'll see what we can do. We don't have it, so it doesn't exist yet. So we're kind of waiting as we answer questions and developing off of that. Okay. Anyone? Okay, well, I'll let you answer any further questions there. Okay, so today, If you're in the face-to-face class, there was a pile of handouts at the door, little table at the door. And if you were online, when you signed on, you were offered a PDF file from me. That is the handout from today. If you were online and declined my file, shame on you. No. Amir will put the URL in the chat room for the file if you declined it. So what I did is, there's a ton of writing today, and these PowerPoint files were in Blackboard, but what I did is I printed them out, so if you're in the face-to-face class, you should have gotten the handout. We're not going to go over every slide, but I wanted to provide the written notes so that you've got the notes today. The only slides you don't have from today are the questions we'll be doing and the homework, which minimal writing. Okay, so just, I don't think you have this one. This is just a review from Monday. Again, when you're doing vertical analysis, the base with the balance sheet is total assets. With the base with the income statement is net sales. You might need to save it if you retrieve it there. That's what they're saying. Sometimes you need to save it or look in your downloads folder so you can deal with that. Okay, so what we're going to be doing is we're going to go through several ratios today. You need to know what group the ratios are in and what direction kind of they go. But before we get there, the cash flow signs of a healthy company. So chapter 13, chapter 12, we're on chapter 13 now. Chapter 12, we read statement of cash flows. Statement of cash flows has three activities. It has operating cash flows, which come from why we're in business. And then we have investing cash flows, which come from property, plant, and equipment, long-term assets. And then we have financing, which is long-term liabilities and equity. So when we look at a statement of cash flows in a healthy company, we're going to see that the cash flow from operating activities is greater than net income, that we're generating cash from operating activities. Operations, the major source of cash, that we are purchasing more long-term assets than selling off. This makes sense, right, that we're buying long-term assets, we're buying buildings, we're buying equipment, we're investing in our business. And then financing activities, we have a healthy blend of equity, issuing stock, and not all just debt that we're issuing. Okay, so now we have another question. The percentage change in financial statement balances, so this is going back to Monday. So the percentage change in balances, this is horizontal analysis. The very first thing we did Monday is computed by dividing the dollar amount of the most recent period by the base period dollar amount. Okay, so on this question, what it's saying is dividing the dollar amount of the most recent period by the base period dollar amount. On horizontal analysis, what we're actually doing is we're dividing the change by the base period amount. So when we're doing horizontal analysis, we're taking the change, not the first year divided by the base year. That's trend analysis. But when we're doing just the percentage change with financial statements, how much did this change from this period to next? We're analyzing, we're taking the change and dividing by the base period amount. This question is going to close in 5 seconds. So we're going to close it in Okay, so now we get into the land of ratios. Ratios are a way we have to analyze what's going on with a company. There's 5 groups of ratios. And the first group is measuring the ability to pay current liabilities. And you're starting to see why I did the handout today. So you've got all these slides. Your responsibility will be able to identify which group a ratio falls in. On the exam reference sheet, I would urge you to download it from Blackboard. It will give you the formulas for all the ratios, so you don't have to memorize them. You do, however, have to know which groups they fall in. So the first group, we're going to go through all 5 groups today. The first one, measuring the ability to pay current liabilities. This is also known as liquidity to some extent, measuring our liquidity. Can we pay our current bills? There's 3 main measures of that. The first one, it really isn't a ratio, it's a dollar figure. And so we're going to go through all 3 of these. Okay. Working capital. So again, working capital is our current assets minus our current liabilities. When we see the word current there, it means that it's going to be, current assets are those assets that are going to be cash or turned into cash or used up within the next 12 months. On the other hand, current liabilities are bills we need to pay within the next 12 months. They're things that we know, they're liabilities, debts that we have that have to be paid within the next 12 months. So working capital should be positive. We should have more resources than debt is basically what it comes down to. Rule of thumb, the more working capital, the better. These last 2 lines are not that important. I think it's probably, these I would not worry so much about, okay? If I were looking at this, I would know that the more working capital, the better, and working capital is your current assets minus your current liabilities, plain and simple. Okay, it's a dollar figure. Now, it doesn't give us any relative measure. It's just a dollar figure. We want it to be above 0 because we want to have enough resources to pay the debts we know are going to be due. Caesars Entertainment Corporation, which is who owns Caesars Palace, Las Vegas, and lots of other casinos, their working capital is something like $18 million negative. Caesars is negotiating bankruptcy currently because they don't have enough cash to cover their current debts. Okay, the current ratio. So net working capital is a dollar figure. That doesn't give us a relative figure from year to year. If we want to compare year to year or we want to compare to another company, we need to put it in some ratio measure. So what we'll do here is current ratio is our current assets divided by our current liabilities. It's another measure of our ability to pay current liabilities with current assets. The higher current ratio indicates the better. So the higher your current ratio, you would absolutely want your current ratio to be above 1. Generally, you'd like to see it at 1.5 or even 2, somewhere in that range. It's going to vary according to industry, and you're going to look at it over time too. So you look at the trend over time. Is your current ratio improving or is it deteriorating? So we'll see a little bit of that today too. Okay, the quick asset test ratio, that is a more stringent measure of our ability to pay our debts, our current liabilities. So with the quick ratio, the numerator, instead of being all our current assets, it doesn't include inventory. Because the thinking here is, if we have to pay our debts quickly, we can't pay our debts with inventory. It'll take us time to sell inventory. So we'll just look at the assets that we can get to quickly, hence the name, quick ratio. And so we take the smaller numerator, divide by current liabilities. A ratio of 0.9 to 1, somewhere in that range, is acceptable. Remember, this is a more stringent measure, so it can be a little bit lower. Okay, so we're going to do two homework problems. One we're going to do a quick ratio in, one we're going to do a current ratio in, just to buzz through these pretty quickly. Short exercise 13.6. By the way, yesterday I emailed out all the how-to videos and all the homework problems. These are very short, but if you need them, they're there. We're going to be doing most of the homework today in class, or did it Monday. There's a few we won't do, but those are in the links I sent out yesterday. So we have a company. They gave us a balance sheet on it. So in My Accounting Lab, you click on the button and the balance sheet will be there. And we're asked to compute their quick ratio at December 31st, 2014 and 13, and then gives us a list of other companies' quick ratio. Okay, so first thing we're going to do is we're going to do the quick ratio. The formula is on your PowerPoints. It's taking cash plus short-term investments plus receivables divided by total current liabilities. And what I'm going to do on the next page, I'm switching to show the balance sheet that we're given. So we're given a balance sheet because we need to be able to take the cash off, the short-term investments, and the receivables and divide by total current liabilities. So this is the balance sheet we're given, and we have to first of all calculate this for 2014. So I'm going to take my cash, my short-term investments, and my receivables, add those up, divide by current liabilities, and I get 1.2. Okay, so that is my quick ratio. That's above my rule of thumb that it should be above 0.9 to 1. So this is good. It's 1.2. It's above that. This is 2014. We're going to do the same thing for 2013. So in 2013, we're going to take the same numbers, cash, short-term investments, receivables, divide by total current liabilities, and we get 1.07. Okay? Okay, so we've done 2014 quick ratio and 2013. I'm going back to the original page now. So our 2014 quick ratio is 1.2. Our 2013 was 1.07. So when we're asked about if it's improving or deteriorating, the company itself went from 1.07 in 2013 to 1.20 in 2014. Okay, that is improving. Okay, so it's improving to go from 2013 to 2014. You can also go into Blackboard and download the Chapter 13 PowerPoints as well, because the file is the same essentially. Okay, so 2013 and 2014. I'm wondering if there's a pop-up blocker too, because sometimes those get stuck. Okay. Okay, so it's improving because it went from 1.07 to 1.2. The quick ratio, the higher the better. And when we compare them to the other companies listed, the 1.2, the most recent quick ratio, is better than the 0.74 for Baker, the 1.06 for Colvin, and the 1.09 for Dunn. So that one, that's what you do with the quick ratio. So the quick ratio, asset-test ratio, it means the same thing. Okay, so our next homework problem, we do the current ratio. In the current ratio, I actually put these, this is 13.6. We're going to go to 13.5. So we're going to go backwards. A different company. We're going to compute the current ratio for 3 years. So it's 2012, 2013, and 2014. And it's asking, is our ability to pay current liabilities improving or deteriorating? This is a nice, quick little exercise. What we're going to do is our current ratio is current assets divided by current liabilities. And the total, we can either have the word total there or not. I'm not sure why I put it here. I think I was just emphasizing it would be all our current assets divided by all our current liabilities. But typically you see it current assets divided by current liabilities. So for 2014, we're going to take current assets divided by current liabilities. Okay, and when we do that, the 610 divided by 382, we get 1.6. So this one's very easy. You're given a table, take your current assets, divide by current liabilities. We do the same thing in 2013, and we get 1.46. And then 2012, we do the same thing. So we go across the way. And what we're going to see here is the current ratio when it's asking, the question asks if it's improving or deteriorating. And we look in 2012, we look at the oldest year, it was 1.3. 2013 was 1.46, and 2014 was 1.6. So it's improving. The higher the better for the current ratio, the higher the better for the quick ratio as well. So we are improving over time on this one. Okay, so now we're going to have a question. It's coming out to you. The asset test ratio reflects the company's percentage of total assets financed with total debt. Okay, now looking at the formula for the asset test ratio or the quick test ratio, we see that the numerator is cash plus short-term investments plus receivables. Is that numerator total assets? No. So this question fails right away. Also, the total debt, it is not total debt. It's going to be, it's just current liabilities. Current liabilities are not total debt. Current liabilities are only those liabilities that are due, only that debt that's due in the next 12 months. So this one is false. Okay, so we're going to close the question in 5 seconds. Okay, next group of ratios. So next group of ratios are, there's 5 in this group, and they're dealing with turnover and cash conversion cycle. So what we see in this group is we will, first of all, the inventory turnover. And the inventory turnover ratio is a measure of how many times you sell your inventory in a given year. Rule of thumb is the higher the better, okay? Higher the better for inventory turnover. This will vary widely from industry to industry. A grocery store should have a very high inventory turnover because they're constantly selling their food. They don't want their food sitting on the shelves for long periods of time. So a grocery store would have a very high inventory turnover ratio. On the other hand, a jeweler has a much slower inventory turnover ratio, and their products don't spoil with time, so they have much longer selling periods. So inventory turnover, everything else being equal, the higher the better. The next one is days inventory outstanding. This is a measure of how many days it takes to sell your average inventory item. So it's related to the prior one, but it's kind of the inverse. How many days on average does it take you to sell your inventory? So this one, the lower the better, okay? Because days inventory outstanding refers to how long it takes to sell inventory. Again, I handed out the slides. If you don't have the file, you can download the Chapter 13 PowerPoints from Blackboard because this is all on there too, because I know you're not going to have enough time to write it down today. Otherwise, we would take a very long time to get through these. So Luke, we're not going to write down the slides today. We're just kind of hitting the high points of this, okay? So you've got the slides in front of you. You've got this written down, and I'm pointing out the important things on the slides. Okay. So measures accounts receivable turnover is how long it takes your measure how your ability to collect cash from your customers, and it's this average of the number of times your receivables have turned into cash over the year. Rule of thumb, the higher the better. Okay? You want to turn over your receivables over and over and over. Okay, so receivables turnover, you want to keep turning those over. You want to keep the cash coming in. Okay, you want to get your cash coming in. The next one is kind of the reciprocal of that. This is the day sales outstanding. How long does it take you to collect? How long on average does it take you to collect your receivables? This one you want to be as low as possible. How long does it take you to collect from your customers? You want your customers to pay fast. If they pay fast, your days sales outstanding is going to be low and your receivables turnover is going to be high. So they are related back and forth like that. Okay, so we've done the receivables turnover. We've done, okay, so we did the receivable turnover. We did the inventory turnover. So we start with inventory turnover, go to days inventory outstanding. Then we did the receivable turnover, days sales outstanding, how long it takes us to collect the sale. Next up is accounts payable. So all of a sudden we're looking at us paying our bills. So on general, accounts payable turnover, how many times a year does the entity, do we pay off our accounts payable? Okay. And the flip one of that, the flip side of that is on average, how long does it take us to pay our accounts payable on average? How many days? And you want the number of days to kind of correspond with your payment terms from your vendors. If you buy everything net 30 days, then you want this to be around 30 days. You don't want to be 45 days because that means you're violating all your credit terms and that can hurt your credit rating ultimately. So accounts payable, you certainly want to use the free credit, the free use of the money, as long as you can within the terms of the credit. So we had the inventory turnover, we had the receivables turnover. So inventory turnover is us selling it, receivables is us collecting for it, and payables is paying our suppliers. So those all go together to be the cash conversion cycle. How long does it take from the time we make an inventory item until we collect cash from the customer? So we're talking about days inventory outstanding. How long does it take us on average to sell our inventory? And then how long does it take us on average to collect the cash for the sale? And then how long on average does it take us to pay our bills? That's a cash conversion cycle. In a perfect world, that's going to be as small as possible. We want this number to be low. We want to collect our cash rapidly. We don't want to wait months and months for our cash to convert from inventory into cash in our pocket. So this rule of thumb, our cash conversion cycle, we want all these to be low, as low as possible. And again, there's not a firm set number. We're going to be looking at this, comparing it over time. Okay. Now, next question. So next question, a high inventory turnover may indicate that a company is experiencing difficulty selling its inventory. Okay, so high inventory turnover. Inventory turnover is how many times a year we sell our inventory. Okay, so this is true or false. So if we're selling our inventory many, many, many times over during a given year, does that suggest we are having trouble selling our inventory? No, it suggests the opposite, right? Because if we're selling it over and over and over, that's indicating we're not having trouble selling our inventory. So you want to make sure you get your answer in. We're going to close the question in about 5 seconds or so. Okay, next group of ratios. So the next group of ratios looks at our overall ability to pay debt. Now notice that this is not our current debt. This is just all debt. So this leverage group is total debt. It focuses on all our liabilities, not just our current liabilities. So when we started this out, we had the ability to pay our current liabilities, which is kind of liquidity to some extent. Now we're looking at our ability to pay all our debt, not just the current liabilities. So that's what's different between this group and the group that we started with. So we have the debt ratio. The debt ratio is our total liabilities to total assets. It's basically looking at the percentage of total assets financed with debt. And debt is all liabilities, not just current liabilities. It's all of them. So our debt ratio, if we had a debt ratio of 1, that means we financed everything with debt. We have no equity. A ratio of 0.5 means that half of our assets were financed with debt. Okay? Now, the higher the debt ratio, the more risky. Okay? The higher the debt ratio, the more risky. Why is that? The more debt we have, the more principal and interest we're committed to pay. To grow our business or to operate our business, we can do it with funds from 3 sources. One of them is funds from operations. We make money from operating. That's great. We can plow those funds back into the organization to grow. Another way is to issue debt. Okay, if we issue debt, we're borrowing. Okay, and when we borrow money, we are committing to paying it back. So we have to pay the principal back, and we have to pay interest on the debt. We are legally obligated to do that. And we say it's more risky because we have that additional payment that we didn't have to pay before. You yourself, if you go out and buy a new car and you have this car payment, that puts you in a more risky situation than if, obviously, if someone had given you the money for the car and you didn't have the car payment. So corporations find that the same. Now corporations can also issue stock to support their operations, and the stock, shareholders give you money for your stock, and then you can use the money. There is no required payment. There is no required payback, but there will be pressure from shareholders to build the value of your corporation and occasionally sometimes to pay dividends, but there is not the legal obligation like there is with debt. With debt, you have to pay the principal, you have to pay the interest, so you have that's why it's considered more risky the higher the ratio. Okay. You are typically, this ratio is typically, usually not going to be greater than 1. You would have to have negative equity to do that. So, but just as a rule of thumb, that your debt ratio, you certainly want it to be lower than 1, probably more in the neighborhood of 0.5 or something, but it's going to vary according to industry. If it's greater than 1, you're in a situation where you've borrowed more than you have assets, which is not good, and you have negative equity, which means you've lost buckets of money. This is actually the situation that Caesars Entertainment finds itself in. Caesars Entertainment, Caesars Palace, all those, they have they have way more debt than they have assets. So if they were to suddenly go bankrupt, they could not pay off their assets at all. There would be nothing left for shareholders. They would not be able to cover even their debt. But anyways, debt carries risk because you have these required principal and interest payments. So speaking of interest, there's the other ratio in this group, the leverage group, is the times interest earned ratio, or the TIE ratio. And this ratio measures the number of times our operating income can cover our interest expense. So this is kind of a relative measure about how much debt are we getting ourselves into. Are we making enough money to cover our interest expense? So the rule of thumb, the higher the better. Because if the higher your times interest earned, that means you're earning way more than the interest on your debt, and you should be able to handle paying your interest. Okay? If you have a low ratio, like, well, certainly less than 1, but even hovering 1 or 2 or 3, you might have some difficulty making your debt payments, covering the interest. So the homework problem we're going to do now, we're going to calculate the debt ratio, and we're going to calculate the times interest earned ratio. So we'll try both of these out. Okay, so we have a company and we're told to calculate the debt ratio and calculate the times interest earned ratio and then make a comment about whether they can pay their debt or not. So first thing we're going to do is requirement 1 says to compute the company's debt ratio. So the debt ratio, like you have on the PowerPoint in front of you, is total liabilities divided by total assets. Okay? So total liabilities divided by total assets, we're going to be taking our total assets. Our total liabilities off the balance sheet we're given is $5,844 divided by our total assets will give us our debt ratio of 0.804. So the debt ratio is 80.4%. What that means is this company has financed 80% of its assets with debt, which seems pretty high. Okay, I mean, it's not saying it's absolutely wrong, but that is a pretty big percentage to have financed by debt. So only 20% is financed by or supported by equity. So that was requirement 1. Requirement 1, we calculated the debt ratio, came up with 80.4%. Requirement 2 is times interest earned ratio. Times interest earned ratio is going to be our income from operations divided by our interest expense. So to get these numbers, we need to go to the income statement. The last one, we did the balance sheet because we were looking for total liabilities and total assets. This one, income statement, our income from operations is the income before income taxes of $1,230, add our interest expense. So income before operations, we have to kind of add, because we're not given income from operations, we have to take our income and add back the interest expense and divide by interest expense, and we get 7.7. That's a pretty high number, because what we're saying is that our income from operations is over 7 times the amount of the interest expense we have to pay. And that seems pretty good. Again, there is not a strict rule. We would look at this over time. We would look at it compared to others in the same industry. But just looking at this from the outside, that seems pretty strong. Okay, so the last question on this homework is their ability to, how does their ability to pay debt look? Well, the answer to that is it's ability to pay liabilities and interest expense is mixed because the debt ratio was pretty high. The debt ratio was 80%. That's a pretty high percentage. But on the other hand, the times interest earned was 7.7, which is pretty strong. So we can't draw a strong conclusion here. We would say it's mixed because we've got some of both here. Okay, next group up. Next group up is measuring profitability. Okay, measuring profitability, there's lots of different measures of profitability, lots of various ratios. In the far right-hand corner in the bottom, earnings per share, we talked about that when we did the income statement. That's calculating how much we're earning per common share. The big one here, all of these are used to some extent. But the big one I see here is gross margin percentage. The gross margin percentage is taking the gross margin and dividing by net sales. Okay, and this was quoted frequently. It's saying basically how much do we make just by selling the product before covering our other costs. So taking the cost of the product, the cost of goods sold, away from the selling price, that's our gross margin. So that's what we have to work with to cover our other operating expenses. So that's a gross margin percentage. Other ones we see, operating income percentage works much the same way. Again, I gave you these on a handout. I don't have them on PowerPoints, but I wanted to give you those. I'm just looking to see where we're going next. So those are listed there. Again, I think you have a homework problem that has you calculate a few of those. I gave you the link for it so you can walk through that. But you will have the formulas on the exam. So the last group we have is the analyzing the stock investments, looking at how a stock investment performs. The most widely quoted one of these is the price-earnings ratio, and this is actually in the Wall Street Journal. PE ratio, it's called. It's taking the market value of a share of stock, dividing by the earnings per share, and basically what that's showing is the market price per dollar of earnings. Okay, so if you look at Wall Street Journal listings online, it'll have the PE ratio. It'll be abbreviated P/E. That's what this is. So it's telling us how much the market values each dollar of earnings, earnings per share. Okay, so that's the biggie in that group. Ratios. So we have ratios at our fingertips. When you take your finance class, you'll do a lot of ratios. You do a lot of ratio analysis. The limitations are that it's focused on the past, and it's just a snapshot of a moment in time. You need to look at it over time, several years. You also need to compare to peers or peer groups or others in the same industry. Okay, so now for this question, ratios that test liquidity include all of the following. Now, when I'm talking about ratios that test liquidity, another way to phrase this question is ratios that measure the ability to pay current liabilities. If you have the handout, it's on the front page, the lower right-hand corner one. The slide that says ability to pay current liabilities, there are 3 measures listed there. The ability to pay current liabilities is the same as ratios that test liquidity, okay? Okay, and basically when we're measuring liquidity, we're looking at net working capital, we're looking at the current ratio, we're looking at the asset test or quick ratio. The debt to total assets is a leverage ratio, so it's not going to be that one. This question will close in a few seconds, so make sure you get your answer in on that one. And that brings us to the end. This chapter is not meant to be an overwhelming chapter, just kind of sampling different things in the chapter. It's to the end of this. It's to the end of this class, so I want to say good luck on all your finals. If you have any questions, email me. Remember, emails for the extra credit need to be in by 1 on Friday. So good luck. I hope to see you in the future.